Hi, I'm Brennan Decima, owner of Decima Wealth Consulting. Today we're going to talk about rule number 2 of a successful retirement plan, and that's sequence of returns risk. And that's a concept most people aren't aware of, but it can quietly wreck even the best designed nest eggs. And really the nuts and bolts of sequence of returns risk is this. It is getting a very bad market right out of the gates in retirement. So if you think about when you're working, it's normal to have market ups and downs. And the more risk you take when you're working, as long as it's diversified, the better off you tend to be over the long run. You know, buy into equities, buy into growth stocks. They tend to grow, and compound over time. And when we have those dips in the road, you're capitalizing on them. Your paychecks are contributing, your dollar cost averaging, so you're buying low when you're working. You get more shares at a cheap price, you recover quicker, you grow more over time. Well, sequence of returns risk is when the opposite of that happens. You're no longer contributing, you're now depending on your nest egg, and you have that risk. And when the market drops right out of the gate in retirement, instead of dollar cost averaging in, we're now potentially creating quicksand. Your portfolio is down, you withdraw and bring it down further, and now you're selling low. You're locking in those losses so you have less shares for the recovery. And if we have a prolonged market downturn, now most of our recent ones have been quick, but the tech bubble burst, we had 3 years of down markets. 2008, we had multi-years before it got back to even. So if it is a prolonged sequence right out of the gate in retirement, this can become really, really impactful and really wreck a well-designed plan. If you do have questions on how to create that protection bucket, how to limit sequence of returns, hit subscribe or comment checklist in the comments, and I'll send you a free retirement checklist.